Ask two investors what a building is worth, and they will often agree on the income long before they agree on its value. It's a fascinating paradox, isn't it? You can literally look at the exact same rent roll, the exact same tenant, and the exact same building and easily agree on the cash coming in the door. But you might start a bar brawl over what the actual valuation should be. So, how does that actually happen? What bridges that massive gap between a property's raw income and its final market price? Well, the answer lies entirely in how the market prices a single pound of property income at any given moment. Welcome to The Explainer. I am absolutely thrilled to have you here today because we are going to completely demystify commercial real estate's most critical, most powerful, and frankly, most misunderstood metric. We'll be unpacking some brilliant insights from Forbes LeBrock to reveal the hidden mechanics behind cap rates. We're going to explore what actually drives them, how they secretly reprice assets right under your nose, and most importantly, what their movement does to your debt. Let's just jump right in. Section 1. Beyond the basic formula. Okay, let's dive into this by looking just a bit beyond the standard textbook definition that you'd find in basically every introductory finance course. The cap rate in commercial real estate is simply your net operating income, your NOI, divided by the current market value or purchase price. For example, a property producing £600,000 of annual NOI valued at £10 million carries a 6% cap rate. Simple, right? And because it's just math, it's totally reversible. Apply a 6% market cap rate to $600,000 of income, and you arrive right back at that £10 million value. But I have to warn you right now, treating this merely as a math formula to memorize completely misses the point. If you stop at the calculation, you are missing the entire story of the asset. And this brilliantly illustrates the paradigm shift we really need to make here. Your net operating income, that is a hard fact about the building. It's the leases, the actual bricks and mortar, the real cash generated. But the cap rate? That is a pure judgment about the market. It doesn't measure the building at all. It measures market sentiment and risk toward that specific type of income in that specific location at this exact point in the economic cycle. Furthermore, because value sits at the bottom of that fraction we just looked at, cap rates and values move inversely. That means when cap rates go up, property values go down, even if your income stays exactly the same. Section 2. What actually drives cap rates? So if the cap rate is a market judgment, we really need to ask, who is making that judgment? Cap rates aren't just handed down from on high. They are actively pushed and pulled by totally independent macroeconomic forces. Let's rapid fire through the 4 primary drivers at play here. First, interest rates. These basically set the floor. A cap rate is an income yield, right? So it has to compete with every other yield an investor could buy. When the risk-free rate rises, property income has to yield more to stay attractive, so cap rates widen out. This link is actually so critical that the Bank of England tracks it super closely as a systemic exposure. Second is the risk premium. Investors demand extra return for things like illiquidity, tenant risk, or short leases. Third, income growth expectations. If the market expects rents to soar, kind of like we saw with logistics assets recently, investors will happily accept a lower cap rate today. And finally, liquidity. When debt is cheap and plentiful, buyers flood the market. Competition gets tight, and cap rates compress, completely regardless of the building's underlying fundamentals. Which leaves us to a really important realization. There is no universal good cap rate. A cap rate that looks attractively high might just be the market pricing in a risk that you simply haven't fully identified yet. This is exactly why secondary offices or older retail spaces command higher yields than prime logistics hubs. They have to compensate for weaker income durability and much thinner resale markets. So whenever you see a massive headline yield, you need to interrogate it. It usually warrants a lot more scrutiny, not less. Section 3. Going in versus exit rates. Now, let's move along the timeline of a typical real estate deal. A single transaction usually involves more than one cap rate. And honestly, conflating them is an incredibly common and remarkably expensive error. We have to draw a hard line between these two. First up, the going-in cap rate. This is your entry yield. It's the cold, hard reality of what the income yields on day one, before you execute any kind of business plan. Second, the exit or terminal cap rate. This is an assumed future rate, used to estimate the property's sale value down the line. It is a projection. You're basically looking into a crystal ball. And let me tell you, it is the single most sensitive assumption in a hold period model, and the one that investors are most tempted to fudge just to make a deal look good on paper. But if you actually want to survive across economic cycles, you need discipline. The golden rule of thumb for prudent underwriting is to assume an exit cap rate 50 to 100 basis points higher than your entry rate. This naturally reflects an aging asset or a potentially softer future market. Look, if your business plan only works because you're assuming you'll exit at a tighter cap rate than you bought at, you aren't betting on the real estate asset anymore. You are simply making a bet on the market. Section 4. The hidden refinancing danger. Which brings us to the most urgent and, frankly, the most dangerous part of this entire explainer. We need to talk about the consequence that owners feel the most, yet discuss the least. Cap rate movement is a highly dangerous financing event, not just a paper valuation change. Let's walk step by step through this chronological trap. Imagine you buy an asset for £10 million on 600 grand of NOI. That's your 6% cap rate. You finance it with £6 million of senior debt, giving you a totally safe, comfortable 60% loan-to-value ratio. Okay, now 2 years pass. Your building is perfectly occupied. The income is flat or maybe even a bit higher. You've done your job perfectly. But in the wider market, cap rates widen from 6% to 7%. Because cap rates and values move inversely, applying that new 7% rate to your income drops your property value instantly. Suddenly your LTV skyrockets, and when you go to refinance, your lender offers you way less money, creating a massive, massive funding gap. So the crucial point here is this specific number. £8.6 million. That is your new property value. Think about that for a second. A mere 1% cap rate shift in the market quietly wiped out £1.4 million in value, while your building performed exactly as you planned. Your original $6 million in debt now represents a whopping 70% LTV against this repriced value. This is the exact mechanism behind a huge share of refinancing distress today. An owner can run a flawless building straight into financial ruin simply because cap rate expansion evaporated the value that their existing leverage was tied to. Section 5. Correcting the category error. To protect yourself from this trap, we really have to clear up a massive point of confusion out there in the market. People are constantly mixing up different real estate metrics that sound similar but do entirely different jobs. Let's make a really clear distinction here. The cap rate is often loosely called a yield, which causes real trouble. The cap rate is an unlevered metric. It tells you absolutely nothing about the effective leverage or your total return. It simply prices the asset for the market. On the other hand, we have the debt yield. This divides your NOI by the loan amount rather than the property value. It acts as a lender's protection metric to deliberately immune them from the exact cap rate swings we just talked about. Debt yield sizes the loan for the lender. Reading a cap rate as a proxy for debt yield or vice versa is a dangerous category error. Used correctly, the cap rate is just an anchor point, but read in isolation, it completely misleads you. Section 6. Rules before you transact. So how do we actually put all of this into practice? Let's look at the ultimate playbook rules you absolutely must follow to protect your capital before you ever sign a term sheet or draw down a loan. These are actionable takeaways drawn straight from the Forbes-LeBrock methodology. First, treat the cap rate as a market judgment, not a fixed feature of your building. Second, completely separate your going in and exit rates and always underwrite that exit conservatively above your entry. Third, interrogate high headline yields. Remember, they price risk, not bargains. Fourth, and honestly, this is how sophisticated owners survive. Model a plausible cap rate widening against your LTV and refinancing proceeds before you draw the debt, not when maturity hits and it's too late. Finally, because cap rates are moving constantly, use live market sources at the point of transacting, not static historical figures. This whole explainer really builds up to one final, completely essential question you have to ask yourself. Is your leverage protected against tomorrow's cap rate? Understanding the cap rate as a market set price rather than a fixed yield fundamentally changes how an asset should be bought, held, and financed. Its greatest significance isn't on the day you acquire the property. It's on the day you have to refinance it. If you are managing an asset right now and haven't modeled this exposure, you're leaving the most consequential variable in your capital structure completely unmanaged. You're flying blind. If you want to dive deeper into this, I highly recommend checking out the Commercial Real Estate Playbook by Forbes-LeBrock, or perhaps seeking a discreet conversation with an expert to map your specific exposure. Thank you so much for joining me for this explainer, and until next time, keep analyzing the real risks behind the numbers.